you, yes you. Thinking about investing in 2025 but not sure where to start? Stocks, real estate, crypto, bonds, piggy bank. It's overwhelming, right? Well, guess what? You're in the right place. Today, we're breaking it all down in plain English. No financial jargon, no big confusing graphs, just real talk about how to choose the perfect investment strategy in 2025. And don't worry, even if you've never invested a dime before, you're going to finish this video feeling like a mini Warren Buffett. Or better yet, like you with a smart plan. Let's go. First, let's get real about what investing actually is. It's not some secret club for Wall Street gurus or a high-stakes gamble. At its core, investing is simply putting your money to work so it grows over time. Think of it as giving your hard-earned cash a job. Instead of letting your money sit idly in a checking account, slowly losing its purchasing power to inflation. Investing empowers it to generate more wealth for you. It's about making your money work as hard as you do. Here's a simple yet powerful example. Imagine you invest $1,000 into a broad market index fund, essentially a basket of hundreds or thousands of stocks offering instant diversification. Let's say this fund historically grows at an average of 7% annually. In just 1 year, you've made $70, not by doing anything, just by letting your money grow. Now here's where the magic truly happens. In 10 years, that initial $1,000 doesn't just add $700, it compounds. That $1,000 becomes over $1,900. Extend that to 20 or 30 years and you're looking at life-changing sums. That's the incredible power of compound interest working for you day and night while you sleep. It's money-making money, a powerful snowball effect. But here's what most people get fundamentally wrong. They believe investing is about constantly chasing the next hot stock tip, trying to time the market perfectly, or outsmarting professional traders. The most successful investors, those who consistently build significant wealth, are actually the most boring investors. It's a marathon, not a sprint. Consistency beats intensity every time. Before you invest a single dollar, before you even open a brokerage account, you need to lay down your personal financial foundation. You must answer 3 critical questions. And I mean answer them with honest self-reflection. Question 1. What's your timeline? This is your investment horizon. How long until you anticipate needing this money? If you need the money in 2 years for a short-term goal like a new car or emergency fund, then keeping it safe in a high-yield savings account or money market fund is paramount. However, if you don't need it for 10 years or more, for long-term goals like retirement or building generational wealth, then you can afford to invest in growth assets like stocks or equity ETFs. Question 2. How much risk can you actually handle? How would you feel if your investments dropped 20% in a single month, or even 30%? Because history shows us, market corrections and bear markets are inevitable parts of the investment cycle. Understanding your true risk tolerance prevents panic selling and ensures you stick to your plan, even when things get tough. Question 3. What's your goal? This is the ultimate destination for your money. Is it retirement, allowing you to live comfortably in your golden years? Is it a house down payment, getting you into your dream home sooner? Or perhaps your kid's college fund, securing their educational future? Your specific, clearly defined goal is the compass that determines your entire investment strategy. Without a clear destination, any road will do. But only one road will get you where you truly want to be. Let me give you the 3 investment strategies that work for 95% of people, especially beginners. These aren't complex, high-risk gambles. They are proven long-term approaches to building real wealth steadily and reliably. Strategy 1. Index fund investing. This is Warren Buffett's recommendation for most people, and it should probably be yours too. Instead of trying to pick individual winning stocks, a notoriously difficult task, you're buying a tiny piece of hundreds or even thousands of companies at once. This inherent diversification is incredibly powerful. If one company struggles, hundreds of others can pick up the slack, smoothing out your returns. Index funds are also remarkably low cost, meaning more of your money stays invested, not eaten by fees. Historically, the stock market has consistently trended upwards, making index funds a reliable vehicle for wealth creation. Start with a total stock market index fund or an S&P 500 fund. They offer broad market exposure with minimal effort and stress. Strategy 2. Target date funds. These are the ultimate set-it-and-forget-it investment vehicles, perfect if you want a truly hands-off approach. Target date funds automatically adjust your investment mix as you get closer to retirement. When you're young, they're more aggressive with stocks for growth. As retirement nears, the fund gradually shifts to a more conservative allocation, increasing bonds to preserve capital and reduce volatility. This built-in glide path removes the need for constant rebalancing. Simply choose the fund with the date closest to when you plan to retire. It's simplicity and intelligent automation. Strategy 3. The 3-fund portfolio. This strategy offers more control than a target date fund, yet remains incredibly simple and effective. It typically involves just 3 low-cost index funds, a total U.S. stock market index, an international stock index, and a bond index. The U.S. stock fund provides exposure to American growth. The international stock fund diversifies globally. The bond index fund adds stability and helps cushion during downturns. You can adjust percentages based on your risk tolerance. Younger investors might opt for more stocks, while those closer to retirement or risk-averse might lean more towards bonds. Notice what's not on this list? Individual stocks, speculative cryptocurrencies, or whatever your cousin's friend is hyping on social media. For the vast majority of people, especially beginners, those aren't investment strategies. They're gambling. They require immense research, perfect timing, or simply pure luck, and often lead to significant losses. These are high-risk, high-stress ventures that can quickly deplete your capital. Stick to these proven, diversified, and low-cost methods to build lasting wealth without the unnecessary stress and risk. True wealth is built slowly and surely, not through speculative bets. Here's your action plan. It's time to move from learning to doing. First, open an investment account. Don't overthink this. Choose a reputable, low-cost broker like Vanguard, Fidelity, or Charles Schwab. They're industry leaders with user-friendly platforms and low fees. The process is quick, often just minutes online. You'll need basic personal info and bank details. The key is to simply get started. Any of these are excellent choices. Second, automate your investments. This is the most powerful habit you can cultivate. Set up automatic recurring transfers from your checking account directly into your investment account. Consistency is king. This set it and forget it approach removes emotion and ensures you're consistently buying into the market. A strategy known as dollar cost averaging. Even $100 a month, consistently invested over 30 years, can grow to over $150,000. Build wealth on autopilot. Third, choose your investments wisely, aligning with low-cost diversified strategies like broad market index funds or ETFs. If options feel overwhelming, pick a target date fund. These are complete diversified portfolios in a single package. They automatically adjust asset allocation over time, becoming more conservative as you approach retirement. It's a truly hands-off approach, perfect for beginners. Just pick the fund closest to your retirement year. Now, common pitfalls. The biggest mistake is not starting. Procrastination, fear, or waiting for the perfect moment are wealth destroyers. The second biggest mistake is trying to be too clever, attempting to time the market or chasing hot stocks. This leads to underperformance and stress. Successful investors are patient and disciplined. Remember, keep it simple, keep it consistent, and let the unparalleled power of compound interest work its magic. Remember, you don't have to be rich to start investing. In fact, investing is how ordinary people become rich over time. It's about consistent action. Your future self, enjoying financial freedom and peace of mind, will profoundly thank you for decisions made today. Not tomorrow, but today. So take that first concrete step. Stop passively consuming information. Close this video, open that account, set up automation, and begin building the financial future you deserve. Before we go, let's drop some inspiration on you. Chris Gardner, From Homelessness to Wall Street. His story inspired The Pursuit of Happiness. Janice Bryant Howroyd started a staffing firm with $1,500, now runs a billion-dollar company. Oluwatosin Olasende from Nigeria built a personal finance platform empowering thousands through Money Africa. These folks didn't start with millions. They started with mindset, strategy, and baby steps, just like you can. There you have it, a full breakdown of how to choose the perfect investment strategy in 2025. Simple, honest, and beginner-friendly. If you learned something new, don't forget to like, subscribe, and hit that bell so you don't miss our next video on top passive income ideas for 2025. And remember, you don't have to be rich to invest, but you do have to invest to get rich. Until next time, stay smart, stay consistent, and let your money work for you.